Hi, and welcome to my monthly market insights video. My name is Dan Timotich. I'm a managing principal and one of the portfolio managers at T2 Asset Management. Before we get started, just a reminder, this video is for educational purposes only. The opinions expressed in this video are mine and don't reflect the opinions of other portfolio managers. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. All right, jumping right into the good, the bad, and the ugly. The good is pretty easy. The stock market roared back. The Fed paused its rate hikes, and the economy's on solid ground. As for the bad, very little. I guess if you need to point to something bad, it was the failure of Brexit to get the votes necessary in the Parliament to exit the EU. Other than that, everything was pretty good in January. The ugly, that's pretty simple. Politics, politics, politics. A divided Congress is determined to see who can damage who more. It's a sad state of affairs, but we'll get through it. We always do. Let's get to the numbers for January. January stock market performance was awesome. Markets have recovered nearly all of the losses from December, and the rebound was led by small caps particularly. As a matter of fact, last month was the best January that we've had since 1987. That's over 32 years. And remember, this was on the heels of the worst December since 1931. So yes, we had a pretty good month. Looking to sectors, they were all positive for the month. The high flyers were communications, consumer discretionary, industrials, and energy. Even financials finally had a good month. All in all, it's been a great time to be in stocks in the month of January. Looking at this chart, this shows the S&P 500 over the last 2 months. If you remember, I built a large cash position for clients in the fourth quarter in anticipation of a big sell-off, and we certainly got one. By the time we got to Christmas Eve, somewhere around December 24th, 23rd, it was clear to me that the market was way oversold and indicating some disastrous economic conditions going into 2019. That was completely contradictory to what my analysis was showing. I decided to go ahead and reallocate all of my large cash positions, and since then we've been really well rewarded, and the market has rebounded quite nicely. Looking at bonds, this chart here shows the 10-year Treasury yield. As you may remember from my previous videos, I thought interest rates had peaked back in October, November, and it looks like they've bottomed out by the time we got to the end of 2018. At this point, I don't really expect any major shock to interest rates, either higher or lower, but I do expect them to stay range-bound, somewhere between 2.5% and 2.8%, at least until we see some signs of much stronger or weaker growth in inflationary numbers. Moving on to portfolio management and construction, it's important for investors to have a disciplined process, but by really following a process, it's much easier to evaluate investment options and to make educated, well-thought-out decisions. As this graphic shows, a car, in order to get from point A to point B, the car needs to have all 4 of these components working. It needs an engine, a transmission, gas, tires. If any one of these is not working well, you may not get to your destination. And like this car, successful investing also requires a thorough understanding of its critical components. What's going on in the economy and earnings? Are valuations cheap or expensive? What are the markets telling us? By analyzing these 4 components, we can better make decisions for our clients. So let's take a look and see what our financial car looks like. The economy is on solid footing. We have a low inflationary environment with employment strong and expected GDP of 2.5% for the fourth quarter. As for earnings, the market was pricing in a zero growth rate in earnings for 2019. Investors were spooked and the market sold off hard in the fourth quarter. At the time of this video, about half of the companies in the S&P 500 have reported, and 70% of them have reported positive earnings surprises. Thus far, earnings growth rates have been just above 12%. I guess the pundits were wrong in their 0% growth estimates. And like Yogi Berra once said, it's tough to make predictions, especially about the future. This is why experience and process matters. Last month, I talked about the sell-off making valuations very attractive going into 2019. Well, with the recent rally, valuations aren't quite as cheap as they were in December. Forward PEs are slightly above average, but are still justified if the current earnings growth rates hold. Bond spreads have stabilized, and interest rates seem to be within reason given the economic conditions. And finally, the markets will remain volatile in 2019. The major obstacle for the markets has been the Fed. It's too early to tell if they're done raising rates, but they have at least paused, which is a good first step. We will still need confirmation to determine whether or not the recent rally was just a bounce back from a terrible December or if the market is establishing a new uptrend. This is just the start of a new year, and I'd like to reiterate some of my thoughts from last month. First, the economy is fine, and I don't expect a recession this year. We still have to wait and see the effects of the rate hikes from the Fed and what impact they'll have on the economy, but there's no signs pointing to a recession quite yet. Last month, the Fed took a pause from their rate hikes, and the market loved it. I still think the Fed doesn't have any reason to resume the hikes, but at least they're looking at the data to determine what they're going to do in the future. I do expect a lot more negativity from Washington as candidates for president try to establish a platform to run on. There's little chance of any compromise, but there's a big chance of continued division. I'll also be watching the data very closely and expect to be more active in reallocating dollars, just as I did in the fourth quarter. We are not a buy and hold shop. We actively manage client accounts to minimize volatility. That's what's at the core of what we do. And finally, don't get emotional. It never works. If you react emotionally to what happened in December, you would have missed out on January and would have been even more frustrated. If you are a little bit emotional about the markets, you should really consider working with an advisor to help guide you. I hope this video was helpful. Thanks again for watching, and if you have any questions or just want additional information, please give me a call or send me an email. Have a great month, and I'll be back in March.